first, we have Elaine King. Elaine King, hi.
Hi, thank you for coming. Thank you, Carlos.
You got it. Elaine King, so what is it? Tell us what you do and how long you've been doing it.
Okay, so I've been in the industry for the last 20 years. I work with over 1,200 families. I am the founder of Family Money Matters, working with a lot of students. And also, I'm so proud that I am the director of financial planning for Schechter and Everett. I know Mike and Phil for the last 15 years.
Absolutely. Good to go. Thank you, Elaine. And then we got Phillip Schechter. Hey, Phil. Thank you.
Well,
go ahead.
I'm Phil Schechter, born and raised in Miami, Florida. I'm a partner with Michael Everett. We've been together, I think, for 25 years. We specialize in forensic accounting and in tax planning. And welcome everybody to the seminar. Michael, why don't you go ahead next and introduce yourself?
Certainly. My name is Michael Everett. I am also a native Miamian. As Phil said, we've been together practicing for 25 years in the area of forensic accounting, valuation, and tax planning as well. And I'm very happy to be here.
All right, good to go. All right, thank you guys. So Elaine, I'm just gonna go ahead and pass the baton to you. I'm gonna remove myself from the feed so that way you guys can have as much video real estate as possible. You guys all have co-host access, so that means you guys can share your screen and share anything you like to share. Okay, so Elaine, go ahead, take it away.
Wonderful. Thank you so much, Carlos. And I'm so happy to be here with Phil and Mike. And they haven't said that, but they are the leaders in the industry in their field. And I'm so proud to be associated with them. So can you see my screen right now? Financial planning tips?
Yes.
Yes.
Awesome. Okay, so I want you all to, I hope you have a warm coffee or a warm cup of tea. You are in for a treat because we have summarized everything that we've gone through this year. And unfortunately, it's been a tough year, but here you go. We're summarizing the year-end financial planning tips. And so what we're going to do, and you already heard this, I want to make sure that you are all awake because this is an early webinar. So type in the chat one word to describe your finances. Just one word that can describe your finances. That will help me. So sometimes people think it's an obligation or it's a independence. I just want to know what it means to you. So I'll give you some time and thank you so much to those who are answering. And Carlos and Phil, if you can answer too. Fantastic. Awesome. That's a great word. Security. Thank you, Gabriela. So Susie, what does it mean? Or Mike, what does it mean to you? Finances. When I say the word finances, you need more money. Okay, so that's a good, everybody has their own value system on finances. So thank you so much for participating. If you can come up with more words later, I appreciate it. I just wanted to have a little bit of a participation. A work in progress. Caroline, yes, you are on your way. I know it. Okay, the agenda for today, welcome and 2020 in review, 2010 tips, and recommendations. We're going to do the David Letterman show today. Uncertainty. I know, Mike, it is a little bit of a volatile. So here, in case Carlos didn't show up, I always have a backup plan. And this is just a little bit of an introduction of ourselves. We can skip that. So financial stress, right? 90% have been affected negatively, according to a Harvard review. Demand, inventories, and charges cause anxiety. Legacy, reputation, control, decision-making, and that's an accent because I am bilingual Spanish. And here's the important fact. 86% of people suffer from financial stress, and the majority, or 40% of them, is because of lack of their knowledge of finances. And today we are here to reduce your financial stress with a little bit of knowledge. So I want to tell you a little bit about my COVID lessons. And I realized, and this was very humbling, that my risk tolerance is very low for investing, especially when the market tanked in March. I also knew that it's always important to go back to fundamentals and not get distracted by the shiny lights. I'll talk about Tesla later. Diversification and investment knowledge to find opportunities is very important to know the debt versus equity on your balance sheet. and investment based on values and objectives. It's very important to invest based on your values. Impact investing is the best thing that has been invented since I started my career in the late 90s. So now I want to ask Phil to give a little bit of an overview of his world. He lives in the tax world, so let's jump into it, Phil.
Yes. Everybody was so worried and involved in the recent election due to the divisiveness of the candidates, and everybody was tied into that. What's happened now is, now that the election is over and Biden has won, supposedly, well, anyway, so he has won. We have to think about how that affects our taxes, and nobody really spent a lot of time thinking about it. A lot of that deals with the 2 senators in Georgia and whether or not they'll be Republican or Democrats, and if they are Democrats, if Biden will be able to get tax changes passed. So what are the Democratic Party tax policies? They're interesting. We're going to talk about them. One, they want to add additional payroll taxes. Meaning, we'll talk about the meaning of it, but that means they're going to pay 12.5% more payroll tax. They want to increase the tax rates. They want to increase the capital gains tax rate. They want to tax the wealth. They want to tax the wealthy, and they want to get rid of a lot of the estate planning that's available. In other words, to gain more taxes. And they want to increase the corporate income tax rate. All those factors, now we have 1 month to think about, because what if the Congress turns, the Senate turns Democratic, and all of a sudden all these things are passed and made retroactive to January 1, 2021. The next slide, please.
Yes.
You got to go down, push down. So Michael will go through this real quickly. This kind of summarizes what I just said.
Okay. All right. So some of the things that we think are going to happen if the Senate changes in Georgia is the tax rates are going to go up. We're right now they're at, I believe, 35%. They're going to go up to we predict they're going to go up to 39.6%, along with the increase in the Social Security tax. Also, one of the other increases is going to be the capital gains rate, which currently is at 20%, with the possibility of 23.8% with the additional surtax will go up to 28%. So that's gonna definitely affect the ability to invest and the ability for small businesses to make investments, because of the tax rates are going to go up. Phil also mentioned, it's not on the screen, is the increase or the decrease in the gifting exclusion or the lifetime estate exclusion is going to go down. That is going to be extremely impactful on estate planning and wealth transfer. Also,
so the next slide will show.
I got ahead of the slides.
No, you could do some of the slides. So what this one says is, right now, Michael mentioned there's a 20 or 23% tax on capital gains. So if somebody sells a house and makes a big profit, or a business makes a big profit, the tax rates are talking about going up to 39.6. So, you know, that's almost double the tax if you have a long-term capital gain that you're thinking of. The other, and so, you know, it's a huge tax issue. So one of the things that Mike and I are getting are phone calls from people that are saying, well, we're selling our business. Should we close in 2020, or should we close in 2021? And, you know, and I'm advising clients to get their big capital gains tax in now. That may not relate to most people, but someone who's got a big capital gains tax issue needs to think about it. Go to the next slide, Elaine.
Mm-hmm.
And Mike can explain this one. This is the Social Security tax. Go ahead, Mike.
No, I'm going to let you do this one, because
all right, here we go. So right now, if you're a salaried employee and you make 400 grand a year, you only pay taxes on the first $137,000. That's the 12.4% Social Security tax. Let's assume you're making $1 million. You don't pay taxes above 138,000. Now you're going to pay taxes on everything above 400. So that, say you were making $1 million, that's 600 grand extra. At 12%, that's $72,000 of lost Social Security tax. Both the business has to pay it, they have to pay half, and the employee has to pay half of that. So what they're trying to do is take that money and fund the Social Security administration. And they're going to fund it by taxing anybody who makes more than 400 grand, and they lose 12%. And the employee and the businesses are going to lose half of it, and the employees are going to lose half of it. That's a huge change. We've been doing this, Mike and I have been doing this, I think, for 25 years. I've been doing it for 35 years. I'm a little older. And we've never had any Social Security tax over the minimum number. And so this is basically take away from the wealthy and fund the Social Security administration.
Cool.
Next slide.
Well, it's not cool, but okay.
This is Michael can just show you the difference in the rates. It's real simple. I think he said it before.
Yeah, I think I went over before. Currently, the rates are as high as 37%. They're predicted to go up, and that once again, that also depends upon the change in the Senate in Georgia to 39.6%. So once again, this is more of a grab at the higher income earners. Most of the other rates, as you can see, aren't going to change drastically in the other areas. However, that is going to be, you're going to see a large increase in the earnings over $400,000.
The next slide. So this is interesting, and I'm hoping this applies to you, everyone on the call. So if right now you have an $11.5 million exclusion, you can make gifts during your life, or when you pass, you can pass without, with the next generation getting 11.5 million without tax. The tax rate is like 40%. So they're thinking about reducing that and reducing the gifting. So they're also doing all kinds of interesting things. They're reducing what's called the generation skipping tax, which means there used to be something called dynasty trust. You could set up a trust that would go for 300 years and for grandkids and great grandkids and not have to pay tax, and all that gets transferred. They're going to stop that and say you can only do it for 50 years, which is basically one generation. So they're thinking about doing all these changes that are on the screen. And the issue is people are rushing in now and going ahead and making gifts and making trusts and doing all these things while they can before the proposals take effect. And I don't know what's on the next slide.
It's a surprise. Okay, so thank you, Phil, and thank you, Mike, for sharing all your knowledge.
Just as an aside, the 11.58 is for the individual. If you're married, the gift splitting is as high as $23 million.
Mm-hmm.
So I mean, as a year planning tip, I mean, that's huge, because this is the one and only opportunity to be able to transfer that type of wealth now. If they bring it down, Philip was saying, if they bring it down to 3.5 million, you don't have the opportunity to do these transfers. That's why this is the year to do it in.
That's a great point, Mike, and precisely in the holiday season. So if anybody wants to gift anything, and you don't have to gift $11 million, but there's also the, is it $13,000 that you can gift without paying taxes? So right. Thank you. So
also applies to business transfers too. If people are thinking of transferring their business to the next generation in a gifting scenario, this is the year to do it, because you can gift the 11.58 million or 23.1 million if you're gift splitting, meaning joining with your spouse.
Very, very good. Thank you so much. So what does this mean to you? What it means to you is also in broad terms, going back to financial planning, you need to have at least 6 to 12 months of future investments, of liquidity, more or less, in case of any future pandemia. Debt ratio in accordance to your goals. Make sure, because that's a question that I get asked a lot. How much debt is too much or too little debt? And then maintain a healthy margin in your business and in your family. So that's one of the biggest challenges for family businesses, is to know how much to have and what's a healthy margin of return. So now, Phil had asked me to include a little bit about investing. I'm going to really jump through this very fast. you need to invest wisely. So there are 6 factors that are determined to know what you should invest in your portfolio. One of them is interest rates. As you know, interest rates are low. I heard a lot of economists talk about the fact that the Federal Reserve is going to wait for the economy to recuperate until they increase the interest rates. And that's estimated to be in 2022. So for those of you who are considering buying a home or refinancing, it is still a good time, but you don't really need to rush because next year is probably going to be very similar. Debt around the world, all the governments are in debt, and that means there's going to be a lot of bond issues, a lot of opportunities in fixed income. Number 3 as a factor, the S&P 500 and the health of the company that it holds. It's going to be determined of the market. Right now, technology has been really leading the S&P 500, but the return overall hasn't been 30%. It's been an average 10%, which is estimated by Goldman Sachs for the market to go up about 11% in 2021. So if you don't have your money invested, you should. ESG is a new status quo. ESG stands for environmental, social, and corporate governance. And it's very important for companies not only to make profit, but to be good and be good for the community. So look out for this type of investing. Stock market concentration, you should always diversify. We know that from those that don't invest, diversification. And finally, the yields and central banks' balance sheets. It's very important to pay attention to what's going on around the world. The biggest opportunities are in international and emerging markets, which are the markets that have been highly hit during the COVID. And for those of you who have high risk, you should look into emerging markets and international. And these are some charts and the forecast for the next 4 years. So that's on a conservative level. So finally, drum roll, top 10. And I get to talk about the top 3. So the top 10 is save for another pandemic. You should. I mean, you probably think that I'm just a pessimist. I am an optimist for those of you who know me. Emergency funds should be for 3 to 6 months. Avoid a COVID-like preventing by having 12 months of liquidity. If you can. Number 9, plan your cash flow to be lean. Lean because I know all of you in the call are very health oriented. So think about your finances as your nutrition. Debt rates right now in 2020 in the US are 19.28, the interest rate. So be wise and don't have anything in your credit card or any bad debt. Prioritize mobility, less dependability. Prioritize being independent and being able to move, not depending on things. And number 8, expand your horizon when investing. Don't look at your portfolio every day or every week or every month. Look long-term. The savings rates right now are at 0.05. So looking into fixed income and investing a little bit can give you a little more than 0.05, like about 3% is the average. And the S&P has averaged in 2020, 10.7. So Phil, are you ready for number 7?
I'll do number 7, then Michael do number 6, but we have to do exactly what it says. There are more coming, Michael. Number 7, accelerate your gifting or your estate planning now. So some of my clients are doing their gifting now, and you don't have to have more than $11.5 million to. So if you want to gift something, you want to sell your business, you want to give your business to your kids, you want to move some money to your kids, now's the time to do it. And to fix your estate plan. So some people are actually getting rid of the entire $11 million now. So now's the time. Now we are thinking maybe 21's okay, because we're hoping that the 2 Georgia senators will be Republican, at least I am, so that will change. So my clients don't have to rush out and go crazy. We'll know in early January, and we hope that even if it's all Republican, maybe there isn't a rush. But if they are Democratic, hopefully maybe if you can do it in 2021, you'll still have it and they won't start this to 2022. Number 6, Michael's yours.
All right, number 6, evaluating your capital gains and accelerating your capital gains in 2020. What this basically means, and Philip touched on it earlier, is if we think this election is going to go a certain way, you may want to make decisions to divest of assets with built-in capital gains right now because the capital gains rates are much lower and you're going to pay less tax on those sales, as opposed to if you sell them in 2021, you may pay up 28%. So you have a substantial savings on your capital gains tax if you accelerate your capital gains this year. But that's, once again, given what you think is going to happen in Georgia in the next coming months.
So number 5 is to accelerate your income into 2020. So I have a lot of clients that say, I'm going to get paid near the end of the year. Should I throw it in 20? Should I throw it in 21? Normally we'd say throw it in 21. That way you have a year to pay the tax. We're now saying to everybody, put it in 2020. There may be a 4% savings between the top tax rate that you have. And to be sure, accelerate your income into 2020. Number 4, Michael, I know I did that one already, but do it again.
Okay, so once again, we're stressing, and you can see there's a pattern here. We're stressing, and I guess we're sound a little pessimistic that we think the election is going to go the other way. So we're saying the tax, if the election goes the other way and the tax on the gifting increases, we're recommending accelerate your gifting now. If you're going to make that decision to transfer stock, transfer a property, transfer a business, we suggest now is the time, because we can't guarantee if this election goes the other way that these rates aren't going to go up and the exclusion is going to go down.
Number 3 is the Social Security tax expansion. So a lot of people have set up these LLCs because they thought they were easy, and everybody owns businesses through LLCs. You need to now rethink that. We're now considering going back to the S Corps, S corporation elections, because S corporations do not currently have to pay the Social Security tax on their earnings. LLCs do. So we're suggesting to clients to elect S corporation status. That way they don't have to pay that 12.4% on the income. That's now going to be above 138 grand. Above 400 grand. It wasn't stopped at 138. Now it's going to be above 100. So there's a big discussion about electing S corporation status for your LLCs. Hold on. You got to do your introduction, Elaine, and then we'll do number 2 and 1.
Yeah, so if everybody is awake, I did have something ready for number 1 and 2. Anybody in the chat can, guess. And this one is, 1 second, sorry. So my computer took a little cough, I should say. And next one is, there you go, number 1 and number 2. So number 2 is portfolio reallocation. Taxes are going up. Consider tax-free investing. Increased taxes may lead to reduced stock prices. So consider investment options. Look out for investments that are not affected by tax changes. And the number 1 is, are you all there?
You have to go, yeah, but you have to go down, or you want me to just tell them what number 1 is?
You can't see it?
Yeah, it's there. It's.
Oh, my screen only has whatever was there before.
Can you see it, Mike?
I can see it. It's
okay. Cool. Can everybody see it? Gabriela, can you see it? Okay. So who's going to say number 1? Anybody?
Well, I guess we can, what number 1 is accelerate your 2020 plan. Think about Roth conversions. Think about business expenses are better in 2021. Business income is better in 2020. The thing that scares me the most, which is not part of the tax part, is what's going to happen to the stock market if they raise corporate rates. Are all the stock prices going to go down? Should we liquidate our portfolio? Should we own businesses that are foreign businesses that don't have the tax impact because they're not doing business in the US? Those are the kind of things that you got to meet with Elaine and find out what your portfolio looks like. Because when Trump came in and reduced the corporate rates, the stock market rebounded by 25%, 30% right up front, just because of tax savings. Now, if the taxes go back to the old rates and the corporations have less dividends and are worth less, do all of a sudden the stock market crash by 25%? If so, is it time to meet with Elaine and reallocate my portfolio so that I I'm not going to get rid of all of my stocks, but I'm going to maybe look for some stocks that are foreign stocks, look for some rebalancing so that if the market crashes, I'm not stuck with the crash.
You're not stuck with your stock. That very good points, Phil. I wholeheartedly agree. You should have a new portfolio in 2021, and you should be prepared. I don't think it's going to crash at the same rate it did, but it's going to be a conservative growth, not a high growth. So yes, you need to be smart about your investing. So with that being said, we promised this webinar was going to be less than 30 minutes or around 30 minutes. I want you to visualize 2021, reduction of key expenses, extensions of key debts, increased cash flow cycles, be more efficient, value your time. It's so important today more than ever. Always have a backup. Wink, wink, you know what I'm talking about. So hire an experienced professional. Hire an experienced professional like us, of course. And finally, we're here to help you. Mike is here, Phil is here, I'm here. There's a beautiful office waiting for you in 4531. Phil can probably talk, and Mike can talk to you about that a little more when it's safe to be up and running. Do you have any questions? Anybody have any questions? We have a couple of minutes. Mike, do you have any last words, or Phil?
I think we covered it all. I think that there is, for the right people, there is planning. I think that, if your income is less than $400,000, there's not a lot of tax planning. There is investment planning, no matter what your investments are.
Mm-hmm.
More of a time to see Elaine than it is to see Mike and I, unless you qualify in that arena where you need to make gifts and those kind of things. Then you need to see Mike and I for the estate planning and for the income planning. The S corporation elections and things like that. If you don't find yourself in that range, I still think you need to talk to Elaine about your financial planning, because that we all have to change. Even if we have $100,000, we need to make sure that we don't get stuck with a market collapse that affects us. So I think those are the key takeaways from today.
Yeah, I agree. I think to sit and wait to see what's going to happen with these elections is probably not the right thing, because the year is going to come and go. And I think now is the time to do some planning. And now is the time, is probably the most important time ever to do year-end planning and to look at your portfolio and to see whether you want to go into 2021 with the same portfolio that you left 2020 with. Probably not the right idea. I think now is the time to pick up the phone and call Elaine and say, let me get in there before year end. I know everyone's trying to make the best of the holidays, but I think right now is the most important time to make an appointment with Elaine and get on the phone or get on Zoom and go over your portfolio, because I don't think you want to walk into 2021 with the same portfolio as 2020. The market is going to look totally different, in my opinion.
Well, very well said, Mike and Phil. You're the best in your profession, and I respect and admire you a lot. And I really thank all the people that came. We are recording this, so we're going to send it to those who need it the most. Happy holidays. I send you a big hug, lots of health. Please take care of yourself. And let's just hope for a much better 2021. All the best to you. And I hope that you are safe and with your family and your loved ones in the holidays. Thank you very much. Thank you, Mike. Thank you, Phil.
Thank you, Elaine. Take care, everyone.
So take care. Bye.